This is Sebastian McMahon from IA Financial Group, and I'm here to bring you the weekly economic review for the week ending December 18, 2020. So again, I'll be solo today. Mr. Gignac is on a well-deserved vacation, but just want to warn you that next week we will be off with the review, but we plan to record one probably December 30th or 31st. Just to wrap up 2020 and to look at 2021. So we'll be on vacation next week, but stay tuned. There should be one more edition before the year is over for the weekly economic review. So I'll jump right into this week's markets at the close on Thursday. So again, a very positive week for equities, even though we've had a strong rebound since the bottom of March. And even at the beginning, since the beginning of Q4, we've had some volatility in October, but after that we had a very strong November, and the market still gives us some returns in December. So maybe there is a Santa Claus rally this year. So after the week is almost done in Canadian dollar, strong performance on equities, 0.64% for the TSX, 1.25% for the S&P 500, 2.7% for NASDAQ, 2% for EFI, and 0.9% for emerging markets. On the bond side, it was pretty neutral this week. Year to date, about between 8 and 10% return for bonds, so a very strong year for the fixed income market. Equities, if anyone would have told me at the bottom of March that we would see these returns at the end of the year, I would have been doubtful to say the least. So 39% return in Canadian dollar for NASDAQ in 2020 so far. We could have some volatility during the holiday season, but still we should remain in this kind of territory. Close to 15% for the S&P 500 and emerging markets, close to 7% for the TSX, and about 5% for EFI. So when it's all said and done, 2020 will have been a pretty good year in the markets after all. Price of oil higher this week by about 4%. We're at $48.36. The theme is that we're seeing a weakening of the US dollar. And this weakening of the US dollar, because of course economic data in the US are a bit softer there and elsewhere now. They're not converging on a fiscal package. COVID management is lacking there compared to other places. So weaker US dollar usually is good for commodities. So for oil, for gold was up 2.5% this week. We're at close to $1,900 now on gold again. So we touched 2,000 this summer. We had a pullback. Now we're regaining some ground. Canadian dollar and euro, of course, are getting stronger versus the US dollar, which is weakening. So 1.2 for the euro, 0.786 for the Canadian dollar. So very good returns. This week, and a very good year overall for the markets. So an update on the COVID situation. Here, this is from last week. This is the same chart as last week, but it hasn't changed much. United States, we're still not doing too well, 60 cases per 100,000. European Union are in good shape here. I will be updating this chart in the PDF. The Canada, we're seeing some stabilization at the level that we were last week at about 17 cases per 100,000. So in the short term, there's still a risk that we see cases rising, because if the authorities, well, you know that the vaccine is here. There's 1.1 million people in the world that have been vaccinated as of this morning, according to Bloomberg. So we know that this has started, but in the meantime, you don't want to overload your hospital system either. So probably we'll see some more cases, some more gains in cases in the next few weeks and months. But don't be surprised if we have more measures by the government to get us all the way through to the vaccination campaign. So stay tuned on that. In Washington this week, deal before the weekend. It seems to be possible, but maybe it won't be before the weekend. Maybe it will be during the weekend. because we are Friday morning. Yesterday, when I put that together, it was looking likely that we would have something, but now they're talking that maybe they'll work through the weekend, and it's important because they need to avoid another shutdown of the government because the funding of the government ends tonight at midnight, so they need to put another bill. It's a little U.S. tradition that they have, that they had a debt ceiling, and when they reach it, they just kick the can further to next year. So we'll see if they converge on something today, but they want to package the fiscal stimulus with that bill. 900 billion now is being discussed. We went from 2.2 trillion to somewhere around 5 to 700 billion. Now we're back to 900. So we want to send checks to the population, one-off checks. Want to extend unemployment benefits and also to send money to states to be able to manage the vaccination campaign. So a very important bill, and the U.S. economy desperately needs to have this bill coming in. One of the reasons, consumer confidence. Here you have the University of Michigan Consumer Sentiment Index. As you can see, we were between 95 and 100 on the index for the last 4 or 5 years. When COVID arrived, we plunged all the way to 72, and then there was a slight rebound all the way to about 80, and we seem to be stuck at around 80. So consumer confidence did rebound a bit, but we're far from the previous high, so it remains quite fragile. And consumer feels it in we can feel it in consumption data. So on the left, you have the retail sales. As you can see, we had a strong plunge early this year. About at one point was minus 15% month over month in March. After that, we had a strong rebound in April when we reopened some of the economy. And since then, we've been getting back to earth. And last month was negative minus 1.1%. So retail sales are contracting again. You don't want to see that. And on the right, it's a broader definition. It's consumer spending. This is from Up Insights, and it's been falling since late November. So on the left, as I mentioned, retail sales, they exclude spending on services, and services are a large part of consumption. So on the right, you see that since late November, all the way to mid-December, we had a plunge of 11.6% in total spending. So there's kind of this income cliff that we're seeing now. The labor market's not doing too well. We are seeing many people losing their unemployment benefits. So direct checks to households would be a good idea, just to support the economy in the meantime until we can reopen more freely with the vaccine and everything. So you need to manage this transition period. So that's why there's lots of weight on Washington right now. So financial markets, a brief outlook at 2021. We'll dig deeper in a few weeks, but just a brief outlook. First, more gains on Wall Street in 2021 according to the consensus. So here you have the price estimates of the consensus as compiled by FactSet. So FactSet is a provider of data. They compile the forecast from all of the strategists out there, and they build it back to the index. So the consensus is pointing towards a level of 4,000 for the S&P 500 at the end of 2021. So that would be a return of about 10% compared to the current levels. So we agree with the forecast that we should have positive gains on Wall Street. We think somewhere between 5 and 10% makes a bit more sense. So that seems a bit aggressive or optimistic to us, the 10% return, but it's not out of our comfort zone. So we would agree with this, that there's more gains to come. And as you can see, the dark blue sticks are what were the target for every year, and the light blue sticks were the actual ones. So the moral here is that it's never exact, the forecasts, but it's also pretty much always in the ballpark. So consensus is usually right that we should have something around 10%. One of the reasons is that institutional investors are also seeing better corporate earnings next year. Of course, the economy in 2021 should be better than it was in 2020, so that's not a surprise for anyone. But and a lot of that probably is in the price. But what we can see here is the net number of participants that say that corporate earnings will improve is at an all-time high. Last time it was this high, it was in March of 2010. So some of that is in the price, but if we have an accumulation of good earnings seasons in 2021, even if some is in the price, it will be a tailwind for the market. So we're not, we would agree with that, and we think 2021 will be positive. Where to invest in 2021? Well, investors are betting on emerging markets. So here it's the answer to the question, what asset class do you think will outperform in 2021? So as you can see, emerging market is way beyond everyone for December. It was already like that in November, but it's even more pronounced now. Number 2 is S&P 500. Number 3 would be the price of oil. Number 4, the price of gold. So commodities should have a good year. U.S. housing, then Bitcoin, and then 30-year treasuries. So emerging markets, it seems to be in favor, and we would agree because when you have a broadening global economic growth, global economic outlook with the vaccination, that usually helps emerging markets, and it should also help the Canadian stock market, I would add. And also Europe should also be doing well. The yield curve now should be steepening again. When the surveys, the managers that were surveyed by Bank of America, they are asked the yield curve expectations. Well, the net percentage that is expecting a steeper yield curve is an all-time high. So the market is seeing that central banks should stay on the sidelines. So the short-term rates should stay anchored, but the long-term rates should move higher. So 10-year, 20-year, 30-year rates should be moving higher as the vaccination campaign leads to better growth, and better growth leads to more inflation and better economic prospects. So that means higher long-term interest rate. So a steepening of the yield curve usually is good for emerging markets. We already discussed that, but good for value stocks, so financials, cyclicals, commodities. So all of these assets should be benefiting. So again, TSX should be doing well. Europe should be doing well too. So we're looking at a very positive year for cyclicals and values in 2021. So the big leaders in 2020, the FANGs, so the Facebook, Apple, Amazon, should still be doing well in 2021 because they're very profitable companies, but we should have broader leadership in the index with the cyclicals now leading the way. Gold, we are still very positive on gold. The environment remains supportive. We use it to hedge our portfolio for capital gains, but just wanted to make sure that no one out there listens to us talking about gold and say, well, I should put a very sizable part of my assets in gold. Gold can be very volatile. We use it to hedge the portfolio. We have lots of tools. We have a very efficient trading desk. We can put in some gold and remove gold during the night if we want in the portfolio. So we're very agile on that because gold can be also quite volatile. So here, just to remind us that interest rates or well, gold is quite sensitive to interest rates, and if we have a sharp rise in interest rates, something that's kind of violent because there's some change in expectations for inflation that arrives, or economic data suddenly becomes very strong, well, we could have a sharp rise in interest rates, and that would lead to very disastrous results for the price of gold. So if you have a slow rise in interest rates and you have lots of liquidity in the market, gold should be doing well, but still be careful 2021. If you have this kind of movement in interest rates, you could be in for negative surprise. We never have more than 3 to 5% within our diversified funds. As you know, we won't be putting more than that, and we advise that you do the same, that you tread carefully with the price of gold. Finally, what to watch next week will be Christmas week, so there won't be that many indicators coming out. So in Canada, we'll have the October GDP growth. Last month, we had 0.8% month over month. It's September. This morning, we had the retail sales for October. And they were pleasantly positive when they were expected to be flat. So maybe there's some upside for more gains on GDP for October. So we'll see that next week. Building permits are always quite volatile. Last month it was minus 15% month over month. So we'll see if we have a rebound. And finally, in the U.S., Conference Board Consumer Confidence Index should be higher to 97.8 in December. So that wraps it up for the week. If you want to reach us, ia.ca/economy. It's always go to the webpage. You can always subscribe if you haven't done so to the email. So thank you for your trust. Thank you for your business. It's always a privilege to be serving you. We wish you happy holidays. We will be back at the end of the year with a wrap up of the year and an outlook for 2021. But until then, enjoy the holidays, and we'll be back in about 2 weeks. So take care.